Hi everyone, I'm Adam Thurgood of Hightower Las Vegas, and welcome to the Fast and Furious Executive Summary Briefing for summer 2023. There's a longer briefing available on our website if you want to check it out. So what's been fueling the equity market rally? Well, a variety of factors have caused the market to move higher, whether it be the market pricing in a soft landing or future rate cuts. But by far the biggest contributor has been the performance of the tech sector based on optimism around AI. The tech sector is the biggest in the S&P by far, and the biggest names of the tech sector, which are huge weights in the index, have been ripping higher because of optimism around how the AI will impact their business. The S&P 500 is up as a market cap weighted index about 14%, but the average stock is not doing that well. You can see that in the blue line here, which is the equally weighted index, up only about 4%. This is a spread we don't typically see emerge at this degree, so it brings up the question of whether or not this is a sustainable rally. And when you look at it from a liquidity perspective, the answer may be no. Liquidity has been contracting, and these are two tightly correlated series over time. And you can see the market rallying despite liquidity coming in. But liquidity looks like it's going to be headed lower, because in order to get an increase in liquidity, we would need the Fed to provide support, or we would need to see loan growth pick up, and neither are very likely in this environment. The Fed's not likely to stop quantitative tightening or even ease when the economy is ripping higher, and we're also not likely to see loan growth pick up when the credit conditions are tightening. So we've talked a lot about leading indicators pointing towards recession, but we haven't seen one yet. And why is that the case? Well, to put it very simply, it's because the government is spending a whole lot of money. We're running an 8.5% deficit as a percent of GDP. We've never seen anything close to that outside of a major recession or a major war. So when the government is pumping that much money into the economy, it's bound to keep us afloat. The question is, how long will that persist, and whether or not it can offset the cyclical factors that are in play. You know, when we look at leading indicators, a variety of them, we're keeping it short today, so I'm focusing on one. There are many that are at depressed levels that have never been this low without a recession occurring. This is the index of leading economic indicators, and it's suggesting that a recession is on the horizon. Now, we could have a couple of scenarios play out, a soft landing scenario where we get a little bit of a contraction in the economy, to push us up in terms of unemployment a little bit, and maybe by that time inflation is quite low, and so the Fed would then jump in and really cut rates aggressively. We don't think that's likely, because the Fed's worried about a second wave of inflation, and they tell us that at every opportunity they can get. So they don't want to move too early. Now, there's also been some talk about the no landing scenario, where higher rates are just okay for the economy and we don't have to worry about them. In this case, you could see a growth rebound, and maybe it moves forward without commodities picking up that would cause more inflation and the Fed to have to raise rates even more. Again, we think that it's unlikely that we're going to see this play out for a couple of different reasons, but one of the major constraints is just higher interest rates. There's a lot of debt that has to be refinanced coming the back half of next year and into 2026, and higher rates are going to definitely impact corporates' profit margins once this refinancing really is set to occur. So the question is, how are we positioned? Well, in the words of Warren Buffett, cash is king, especially in times of crisis. When we can get 5% plus on short-term cash-like instruments, makes a lot of sense to hold a chunk of the portfolio in cash. And we also are big believers that we're headed for a commodity supercycle where a lot of the supply-demand characteristics play out. Energy is a great way to hedge for inflation if there is a second wave, and there's also been a lack of investment in the space, so we expect the supply concerns around energy to come to a head once we get through this soft patch of the economy that we're expecting. But we're also going to need a lot of base metals as a result of the green energy transition, and copper and silver and some of the other metals that are critical to this build out are going to be in short supply. So we think that there's some asymmetry that is built in there. And of course, we want to be diversified. We still have some exposure to the equity market, both internationally and here at home, but we do have a fairly heavy overweight in cash and precious metals. We've actually gotten some inbound traffic around precious metals, and most people don't realize that gold has actually outperformed the S&P on a total return basis over the last 25 years by a small hair, and done so with very little correlation to the market. It's a great portfolio diversifier over the long run, and in a world where governments are spending money uncontrollably, gold makes a lot of sense to us. While we're worried about the short run, we want to make sure that we focus on the bigger picture and the long run return potential of the market. These orange bars are the price return of the S&P by year. You can see there's a lot of variability there, but when you zoom out far enough and you look at the blue line, which is the rolling 30-year return of the S&P 500, it's pretty consistently positive between 6 and 8%. So we're still optimistic about the long run return potential of the S&P 500 and other stock markets, and we think that we'll be just fine once we get through this soft patch. So with that, we'll leave it for next time. Make sure you check out our other content on the website, and we'll see you the next time around.